Again with our main Tony. Yeah, much better, Tony. How are you?
How are you? Good morning, all.
Good. What's going on? So you shot me an email, said that, well, you've been in the business a long time, and you can't believe some of the things that you've seen, including bad advice from reputable sources. Tell me a little bit about this.
And actually, one people whom you would think would know better. And as we do this, Lee, always I tell people, get specialized professional advice. Whatever somebody tells you, check it out, look at it 5 different ways, because you need to know, even if people were sincere, oftentimes they can be sincerely wrong. A young lady came into the office last week, grandfather's estate. She was a single mom, stressed out. My mom's the fiduciary. I don't know what's happening. And I said, bring everything. We're going to throw it on the table. So we did that. A very, very, very long story, made very, very short. Modest estate. Her grandfather worked in a factory in New Haven, had a rollover retirement contribution, and was instructed by the people who were, quote-unquote, doing this estate at the law office, who say they do probate, to transfer the retirement account where the grandfather didn't have a named beneficiary into the name of the estate. Well, that's a sensible thing, right? That's what you should do. In doing that, they created a $50,000 taxable distribution. So really, when I think of this, as my wife Kathy says, maybe not the stupidest things, Tony. Yeah, there are some stupid things that people are told. When you're given retirement money, this is not bank money, folks. This is income. Treat it like dynamite. You're not looking at $50,000, $40,000. You're looking at that minus the taxes. And this goes on, I can't tell you how many times. We've got to do some real fast stepping to help this poor person. Very happy she came to us, but the amount of ignorance out there is just staggering.
So in other words, somebody gets, when you say retirement, I don't really understand that. Does that mean that person gets money every year because of that person, his retirement benefits will go to her or that family? Is that how that works?
Well, yeah, it's like if you're working on a job, you have a 401k or a 403b, and you separate from service, you retire, or you go from one job to another, and you pass on, and your beneficiary gets this money and says, "Wow, hey, this is great."
Right.
Listen, it doesn't have to be tons of money. They're not looking at that amount of money as quote-unquote money. Taxes need to be paid on that money in most cases.
All right, but we're not talking about money that comes in. There's no thing out there where somebody leaves a benefit. Like, how do I explain it? So you're working for the state of Connecticut, you die, and your family gets, or you choose somebody to get your payout every week or every month. That doesn't work. There's nothing like that.
Well, that's a different thing. That's what's called a defined benefit. This is quote-unquote
one shot.
A retirement account, which is one's an apple, the other's a pear.
Yep. Okay.
I'm talking the pear.
Okay, so she got the $50,000. She wasn't prepared to pay the taxes on it, and they didn't really explain it to her well. So she pretty much has to come up with what, $20,000 or something like that.
Well, exactly. Didn't know it was taxable money, and all she knew when she came to me is something's terribly wrong here, and I don't know what. And this is the kind of thing where I've been involved in situations like with separating families, which are very painful. And you're trying to explain to a family counselor, look, you're looking at that retirement accumulation. That's not $500,000 that you're looking at. It's more like $250,000, because that's compensation or salary that was set aside through the years. When it comes out, someone has to pay the taxes on it.
Right. Now, when somebody takes money and invests it, let's say in wherever they invested, whatever, and they pass away, and then somebody gets that they have to pay the money on what was originally put up, not the whole amount, correct, in most cases?
Well, if many times you have what's known as unrealized appreciation. If I put $20,000 in a SEP plan, and let's just say I had a son and I had no spouse, and I passed on, and by the time I did that was that $30,000, that is money that taxes need to be paid on. The $20,000 probably is money that taxes need to be paid on as well, because I never paid taxes on it. I made the contribution and reduced my income accordingly.
Okay, I got you. So pretty much anything that comes your way, make sure you realize that somewhere between 30 and 40% at least of that money has to go to Uncle Sam.
Well, yes, if it's retirement money. Now, there's a common misconception, and this is really kind of leads us to another thing, as to where people get their bank advice, their tax advice. I have had more things come to me from where people were told things by bank managers or by insurance agents or, whosoever as to what a certain thing is and it isn't. Inheritance money, money in a passbook account, yeah, that's tax-free. But when it comes to taking, like, retirement money or annuities or things like that, be really careful. And I'm a great believer in specialization. Don't get your tax advice from the bank manager. Don't get your legal advice from the accountant and vice versa.
Right.
Don't tell me how to fix your car. I have no idea how to do it. And the problem is, I think, in this multi-marketing society, and because I was in banking, I ran the tax department of a major trust bank in Connecticut for 8 years, on a contract. There is such sales pressure put on these people that they're just cross-selling in order to make numbers and get trips. They don't even know what they're selling a lot of the time.
So let me ask you, so if you go and let's say you decide to take $50,000 and buy IBM for whatever reason, okay? Now you were already taxed on that $50,000 when it was, paid to you as you got paychecks, you squirreled it away.
Exactly.
You said, I'm going to go buy $50,000 worth of IBM, blah, blah, blah. And then you sit on it for 10 years and then you die, but you leave it to your wife. Or let's say you leave it to your son, like you said, and it's got up to $150,000.
Right.
And the kid wants to take it out and go buy a nice car. Does he have to tax the whole $150 because you already taxed going in?
Well, exactly. And you see, that's just it. That money that I squirreled away, I paid taxes on that when I was squirreling away, as opposed to the money that I saved and I never paid taxes on that came out years later.
Okay.
That's the difference.
Okay, but when you invest in something, I guess bottom line is when you invest in something and it grows, if you have spent $50,000 of your hard-earned money and it's accumulated to $200,000, I thought you only had to pay tax on you have to pay tax on the $150 at that point in time, right? Because that's what you made.
Well, not necessarily at all. Really, the question you got to look at is, was I paying taxes on this money all along, or have I never paid taxes on it? That's really the critical.
Right. If you've never paid taxes, you're going to pay.
Exactly.
Okay.
And many times things come out with knee-jerk, oh, yeah. I mean, I had one case of a single girl living in a garage, for crying out loud. She was in an abusive relationship, and her mom, who passed on, left her as the beneficiary of a retirement account, went to see her trusted friend in the bank, and trusted friend in the bank told her, hey, not a problem. Take this money. Inheritances are tax-free. And she went and she bought a condo, was going on in her life, and, moved a couple of times, and years later got this letter saying you owe taxes, interest, and penalties.
Wow.
So you got to be, as I always say to people, like Hill Street Blues, let's be careful out there, folks.
All right, brother. Good stuff, Tony. I appreciate it.
Okay, we'll talk soon.
All right, pal. Tony D'Angelo. Again, fun talking to him. He's got an interesting take on a lot of this stuff. All right, for some reason, I can't talk all of a sudden today. What's going on? All right, let me go chug a gallon of coffee. We'll come back.